What's up, guys? Okay, so the following video is one of our sample classes. This one in particular is on calculating risk and reward with a few different strategies. Lots of people approach these strategies in different ways than we do, and that's completely fine, and it's kind of the way of the market. Our ultimate goal is not to be experts or gurus or anything like that, but just to help new traders learn and progress. And so if you want to learn more about that in these classes, go to the link in the description of this video, and we hope you enjoy it. Plus, thanks for watching. All of this is related to risk and reward, calculating risk and reward in each trade you get into. That's really important, calculating risk and reward in each trade you get into, because not only will that give you a little bit more stability in your trades, but that's ultimately how you're going to find consistency, is understanding the risk and reward in that specific trade before you enter that trade. If you jump in too soon without actually calculating that risk and reward, without actually working on those things, then your trading's going to be all over the place. It's going to be chaos, So the only way to kind of calm your trading down, find consistency in trading, is to calculate risk and reward. Understand your risk and your reward in each trade you get into. And in this class, we're going to be relating that to strategies. And so just to introduce the class, our mission, like we always say, is to not only teach you viable setups that we have proven tested, I back test my setups to make sure they work, but to help you better understand the mechanics of any strategy you choose. A lot of gurus and stuff like that, they're going to teach you, the path to riches with their strategy, and that's really not what we're trying to do here. Because if you can approach any different pattern successfully with a plan, understanding the risk and reward, then you can be profitable with that strategy. But if you're just trying to follow a strategy blindly without understanding the risk and reward in that specific trade, then you're setting yourself up to fail. And so like this says, if you calculate these things, it will give you the skill you need to take edge in this market. So of course, any strategy, it is going to come down to how well your execution is. And this is really where we can help. How do you really execute your strategies? We'll go over that now. Do you want to take over on this part, Mitch? Just because I know you.
All right, I'll go ahead and I'll take over here, guys. All right, so the real key part of, I think, trading, it all starts with getting the right mindset. The first thing we want to do in the morning, we want to get, want to find the right chart patterns and strategies. We want to look pre-market and intra-market, see what's going on. And this is when we're just trying to get to the right stocks. A lot of trading is just getting to the best A+ strategy, and you're going to find your A+ strategy usually by finding the pattern first, combining your strategy, and this is where we get to our second step here, and this is where we start getting to establishing the trade plan. This is where it really starts getting down to the nitty-gritty, guys. This is where you want to set and determine your risk and reward, find the key levels in the stock, draw out your trend lines, your support, your resistance that you found in the pre-market and intra-market here.
For sure. And, we've gone over this PowerPoint before. I've actually added some new stuff to it. But the big thing you want to see here is that you want to do this with every single trade you get into. Before you get into a trade, it's really tempting in trading, and a lot of new traders do this, is just to kind of gamble. You see a strategy you see a pattern that looks halfway decent, and you're just jumping in. That's not what you want to do. You want to set and determine your risk and reward levels before you enter that trade. You want to map out pre-market daily support and resistance before you get into that trade. You want to draw out possible trend lines, support, and resistance before you get into that trade. Because if you just jump in and you actually haven't planned it out, then you're going to get mixed results. You might get good results, you might be bad, but you're not approaching it the right way. You want to plan the trade out not perfectly, but you want to make it organized for yourself in that trade. And like I said, that's how you're going to find consistency in trading, is making it organized for yourself. If you don't do that, you're setting yourself up to fail. And so I can go to the next one, Mitch. Sorry, brother.
All right. And then what it really leads to, guys, is once you've established that trade plan, this is where it really comes down to it. This is where visualizing and executing the trade. If you can really see the trade, I say take the trade. A lot of people have problems with hesitation. Hesitation always comes from not feeling confident within your strategy or not understanding the risk to reward. When you don't understand the risk to reward, you can't have that risk acceptance. And why not having that acceptance, you hesitate. So I always say visualize and execute the trade. If you're able to see it pre-market and really kind of already establish your trade pre-market, then by the time the market moves, if it moves exactly the way that you wanted to set up your trade, you should take that trade every time. Reason why is you plan this trade out. A planned trade is always going to be 10 times better than that random gamble.
Right, and it's really tempting. Like we've gone over it in other classes before, but one of the things that really drags people closer to trading, that makes them want to trade, is that kind of surreal gambling feeling where you don't know what's going to happen. You don't know what's going to happen, and so when you win, it feels really good. But that's what you want to kind of curb, ironically enough. You want to make it organized and not have chaos in that trade. You want to plan it out, obviously, but the way you do that is to determine your risk and reward. So you know how much you're risking, you know what your reward is in that trade. The next thing you want to do, like I said, find key levels, draw out support and resistance and trend lines. And you want to do this in every trade. I can't stress it enough because that's what's ultimately going to lead you towards consistency. If you're having a consistency problem, this might be it here, is you're not establishing a plan.
Yep. I always say that's really the nitty gritty. If you don't pay attention to that middle side, you're never going to even get into this side.
Right. Okay, so now we're delving into actual strategies here. And so the first one we're going to look at is kind of my favorite strategy. It's probably one of Mitch's. It's the VWAP fade. And you've probably heard me talk about it on the stream if you're new here. But it's definitely a viable strategy. It's one I've actually back tested. And so we can go to setting up the trade. And these are really the 5 steps to the VWAP fade. First one is to watch for a bearish trend at the open. This is important because when a stock is underneath the VWAP, it's in a bearish trend, and you need it to be underneath the VWAP for it to actually pull back there. If the stock is above the VWAP, it might be a VWAP projection, but if you're only looking for fades like I do, you're not going to find it if the stock's above the VWAP. So that's step 1. Step 2, it should come with a big washout with high volume through the pre-market support. And now this is huge because it has to wash out in a big way, because whenever it climbs back to the VWAP level, the whole basis of this strategy is the stock getting rejected when it's trying to change trends. So when the stock tries to cross over the VWAP, it can't. So it can't change trends to an upward trend. And so it gets rejected back down. And if it's not a big washout at the open with high volume, if the volume's not there and it's not big, it's not going to have the momentum in your direction. But when the washout is big enough and there's a lot of volume to accompany it, by the time it climbs its way back up to the VWAP, it's more extended at that point, and the momentum's in your favor for it to come back down. And so I hope that makes sense. But this is a crucial part of it that I might not talk about a lot, is that that big volume and a big washout is huge because that's going to give the momentum in your favor. Number 3, do you want to read this one since you're the level 2 guy, Mitch?
Yeah, you got to pay attention to the level 2 when the stock finally finds that new support. And that's why we really pay attention to the high volume, is because there's always what we call bag holders. Bag holders buy up the bottom. Essentially, there's other strategies called like washout longs or kind of buy the dip. There's a lot of different strategies that people could be buying into that weakness. Just like we short into strength, people could be buying into that weakness. So what I look for is if there's any really big orders at the bottom. You shouldn't really be seeing big orders at the bottom, just because if a shorter has already gotten into this stock, he's going to wait for it to bounce so that he can add his shares into it and take a really strong position.
Right, and that's going to hurt your trade for sure.
Yeah.
Number 4, draw a horizontal line of newfound support. And so this is typically the previous low of the day. So whenever a stock comes back down, and we'll go over the chart in a second so you can really see what we're talking about. But when we have that big drop at the open, it's going to bounce eventually, like we've been saying. And so once it finally does bounce, you want to mark down that previous low in the trade. Because most of the time with the VWAP fade, and like I said, we'll go over this a little bit later in this presentation, that's going to be your first reward target. And that's how you're going to have the basis of your risk and reward in that trade. And so at that point, once you see that bounce, you could start calculating your reward from compared to where the VWAP is, which is going to be your entry. And so you'll know what your reward is ultimately going to be. And so this is huge because once you see it find that support and it may be setting up for a fade, a little alarm bell should go off, because that's when you can ultimately calculate your reward and your risk in the trade. You can know if your reward's going to be bigger than your risk. And so that's the big thing. And number 5, that's right, Eric. Know the end at the beginning. Know where you're going to take profits. Know where you're going to stop out of this trade. Know where you're going to enter this trade. Know that your reward is bigger than your risk before you get into this trade. And like we said in the last slide, if you don't know these things, you're setting yourself up to fail. But if you calculate these things, and it's a process, it takes a little bit of time. It takes a little bit of time to condition your brain to just analyzing that risk really quickly, analyzing the reward really quickly, analyzing where you're going to take profits in that trade if it does break the low of the day really, really quickly. But it's a process, and you can get there. If you watch our streams, this is something Mitch and I do with every single trade we get into. Before we get into the trade, we're saying, look, here's my risk, here's my reward. And this is something that Mitch and I actually quiz each other on. If we're in a trade, we say, where's your risk? Where's your reward? Where's your profit target? And so forth and so on. And so you want to do this with every trade. And like I said, the goal of all of this is to bring consistency to your trading. All right, so here's a good example of a VWAP fade. Okay, so big thing here. You locate the VWAP, which is this purple line right here. You can see the purple line. And you wait patiently for your entry. Your entry is going to be to get in around the VWAP or above. Why should you wait until it at least hits the VWAP? Because this can give you a risk that can be measured off of the nearest resistance or support. And so, for instance, what did we say? We want to see a big drop underneath the VWAP, a big drop with high volume. Why do we want to see that? Is because by the time it climbs back up here to the VWAP, it has a tight risk here that you can calculate and analyze. If you get in at the VWAP, it has a pretty tight risk here per the pre-market levels. And so your risk is only this much. But your reward is at the previous low of the day. So your reward is all the way down here. So if you set your risk here, your stop, whatever you want to call it, your reward is much bigger than your risk. And so that's the VWAP fade. Bearish trend, big downward drop, pull back to the VWAP. You jump in short right around here, setting a tight risk level, and you sell a partial at the low of the day, giving you good risk reward. That's the key to this strategy. You ride the rest down. Typically, it's just a partial at the reward level, because that way, if you take a partial here and it does bounce back up, you can get out, and it's a break-even small winning trade. But if it does break down like you see here, you can ride it down to the next support level, take your next partial, and it's all relative to how much sizing you took in that trade, meaning how much you can scale out of it. If you don't take big enough sizing, you're not going to be able to scale out that much. But it's all how you want to approach the trade, and that point is subjective. It's all up to you. All right, so after that, we're going to go over some examples of the VWAP fade for today. Even though I didn't trade today, I don't think Mitch traded today, there was actually a lot of examples when I looked over today's charts of the VWAP fade. And I called a few out in the stream, but we're going to go over those specifically and calculating your risk with each of these trades. Okay, so you can see Cron here faded off the VWAP twice. It faded off the VWAP here and here. Big bearish trend, lots of volume, pull back to the VWAP, and then a big rejection back down. And this was a beautiful fade actually, because look at this follow through. Once it actually broke this low of the day here, it followed through in a really nice way. That's a lot of money to be made there if we were holding it. Unfortunately, we weren't, but the strategy still remains. And it even faded again. And this is what I call a longer term VWAP fade because it's just a much bigger move. It's a much bigger move not only back to the VWAP, but also another big move down. And if you were in this trade, you could set your risk at this previous low right here. And your risk is tight and your reward is big. And that's what we look for. Some more examples. AMD. A little bit smaller of a VWAP fade, but again, big washout at the open. Big washout, a lot of volume. Pull back to the VWAP. You could set a tight risk here maybe. And then a big follow through back down. Especially once it broke down under these lows. Again, really big follow through. Really, a lot of money to be made in this area here.
That's so beautiful.
Yeah, and then AMRN, Mitch and this is a stock that Mitch and I really don't like. I suggest all traders kind of find stocks that you deem unreliable, and if you haven't had good results with it, you just got to go by probabilities. If you haven't had good results before, you may want to just not trade certain stocks, and this is actually one of them for me. Somebody actually called this one out in the stream, though, and it faded really beautifully here. You can see big, voluminous, bearish drop. Pull back to the VWAP, and then a really beautiful washout all the way down to the 1740s. I think this was 19s, and so really big move here as well. And these moves happen with the VWAP fade over and over and over again in the market. That's probably why it's one of my favorite strategies, and it's one that I've back tested. I've back tested it. It has about a 73% accuracy rate, but these moves happen all the time in trading. So we can move forward here. Now, the big thing with any strategy you choose is establishing risk in these trades. So, like we said, with the VWAP fade, it's really simple where your reward is going to be. Your reward is typically going to be at the previous low of the day. So if I go back here, let me see if I can pull this up. If I pull back here, your first reward target is going to be at this previous low of the day right here. And you can see it also confirmed it in pre-market. You can see there was support there as well. And so, especially with the VWAP fade, a lot of times you're going to be trading it off of pre-market support. And you can see, let me draw this annotation here. You can see it. This is your reward. And you can see it confirmed it here. And so, just keep that in mind. I'll go ahead and erase that so you can see it. All right. Now, like I said, this next section is on establishing risk in your trade. And so it's like I said before, you're usually going to use pre-market levels in these type of trades because pre-market levels are the ones that are in front of the most traders. A lot of traders are watching pre-market levels. And so with that in mind, you can use these levels to guide you in that trade. You can use it to guide you in where you should set your risk. You can use it to guide you where you're going to set your reward. And especially if it breaks your first reward target and keeps dropping when you're shorting a stock, you can use pre-market levels to determine where you're going to take your next profit. So here's a great example of it. I think this one was AWX. It was it was ACB. Either ACB or ABC. And so this was actually a VWAP fade as well. But if you're in this trade, you can see the fade. Let's draw it out. You can see the fade here. Whoa, I don't know why I did that. Let me get a better arrow here. You can see the VWAP fade right here off of the VWAP. Now, if you get in here, where are you going to set your risk? Like I said, you use pre-market levels to determine this. And you want to see confirmation in your risk level. And so if you're trying to make a thesis around this trade, if you're trying to create your trade plan with your risk and reward, where's a smart area to make your risk? You don't want to make it too far away because if it's too far away, your risk is going to be too large. But if you look at the chart, it will guide you in that trade. And so you can see you can use this area here as your risk. Why do you want this area to be your risk? Because it confirmed that level in pre-market multiple times. You can see it was resistance here. It was resistance here. It was resistance here. it was resistance here, it was resistance here. And so that way, you know, if the stock breaks over that level and actually holds, not just taps over it, but if the stock holds and specifically opens up over that level, then you know that is your cue in that trade to get out, because it's broken over that major resistance that pre-market showed you, and that's your cue to get out. We can go over another example here. Let me erase some of these. Okay, so we can go over another example. Again, you can see the fade here. Beautiful fade. Today, I think this was Cron. Yeah, this was Cron, as you can see here. And where are you going to set your risk in this trade? A reasonable level would be right here. Why is that your risk? Because, again, if you look at the chart, it was support here, here, resistance here, and here. That's probably the level that this stock bounced off more the previous day. And this is also a good example of if the stock didn't move enough in pre-market. You know, if the stock didn't have high enough volume to where you could see all this choppiness right here, you can see all this choppiness right here, then you can go back on the previous days and analyze the support and resistance that way. And so even if you're just using a 1-minute chart like this, if you go back and look at the previous days, then it will guide you on where to set your risk in that trade. You know, very obvious level here. Again, it was support all in here, resistance here, resistance here. And so it guides you in that trade. And so regardless of whether you want to use pre-market, I tend to prefer pre-market just because it's the most recent support and resistance. But another thing is that the volume has to be there. If the volume's not there in pre-market, these levels are going to be choppy. They're not as obvious. And so when that happens, you got to go back and look at the previous days. And so you can see, again, it guides you in that trade. Let me erase these here.
Yeah, you can see these are just perfect examples time in, time out. If you're not using the important key levels and establishing your trade plan off of those key levels, then your trade's not going to fulfill. But if you go ahead and use those levels to determine your risk and reward, a lot of times you're going to see the stocks going to go into what we call a range bound. And that's what happens to the stock throughout a whole day and a half. It's within a range and it's going up and down through that range. So what you need to do is start learning how to use those key levels to get yourself in the best part of the range so that you can use the range to determine that risk and reward and able to get yourself in the best position. In this case, if we're shorting, so we want to get ourselves on a resistance so that when it heads to the support, we're already getting a reward, let alone if it breaks that support.
Exactly. And so we can move on here. Let's see. All right, so the next thing is that the reward points in these trades, right? If you look at this, you can see the reward levels here. You can see the risk levels, I'm sorry. And again, the reward is at the low of the day. And so first target is the first support that was just touched from the opening breakdown move. Okay, and so again, reward level, risk level, the previous low of the day as I went over before. Second target is the second support down, and you want to use pre-market and historical levels on the daily chart. But like we went over in a previous class, a lot of the time, you know, some of the biggest areas that stocks are going to bounce off of are half and whole dollars. You know, that's where a stock's going to bounce a large majority of the time, is at half or whole dollars. And a lot of times the pre-market levels will actually confirm that. And so, for instance, say a stock went down to 750, that's an obvious area to take your next profit as well, because in that point, the chances of it bouncing back up are pretty high. And so, again, here's another graph just kind of showing the risk and reward with these type of trades. So you can see here, beautiful fade. I'm not sure which stock this was, but you can see your entry here, right around the VWAP, getting rejected and coming back down. And you can see your risk level is only up to this point here per pre-market. And so you enter in here. This is your risk level. Pretty tiny box. But your reward level, like we said, is that previous breakdown low. Right down here, the previous low of the day. And so your reward is from here to here. And your risk is from here to here. And so your risk is substantially larger than your reward. And that's what you want to see in each trade you get into. You could get into one-to-one trades, but it's all relative on how accurate your setup is. If your setup is super accurate, then you could probably, handle a little bit worse risk to reward. But if your setup is, kind of a coin flip, you definitely want to see better risk and reward in that trade, obviously. Because if not, you're ultimately going to be risking too much in those trades. And so again, you enter here, risk is small. You enter here, risk is small, but your reward is substantially bigger. And a lot of the times with any trend, so previous highs and lows are going to be significant. And so when a stock's in a bearish trend like this, a downward trend, a lot of the time the stock is at least going to test this low right here. It's at least going to test it a large majority of the time. And so that's why it's smart to take profits here. Because if it tests it, you could take profits, get some money in the bank, and then if it does bounce up and go crazy and squeeze up here, you can get out for a break-even trade. But if it does break down really nicely like this, it's a much bigger winner, and so you're setting yourself up for success.
Yeah, this is the part that we use in our strategy to really just increase our accuracy. A lot of times you're going to have those stocks that bounce. If it bounces and gets out, you get out, But the best part about our strategy, it gives you an ability to make some money and then really get yourself set up for the home run.
Right.
And that's what you want to do with just about almost every strategy, unless you're doing more of a scalping strategy. And that's really what we try not going for. We look for a little bit bigger than a scalp. We're not trying to take a one-to-one trade. We're trying to increase on risk to reward so that we don't have to be so accurate, and then we can get our profit from the real key is where it helps us out is we can get our profit from even winning and losing trades. Let's say we had 2 losing trades, we can go ahead and make 1 good winner. And because we're setting that risk to reward, we go ahead and we make up for our losses and either end up break even or sometimes shortly in the green.
Right. And I could show you guys just a second and show you guys my stats from this past week, just so you could see. We're not scalping here. We're holding it. My average hold time for a winning trade last week was 41 minutes. And so a few people have accused me of scalping, and maybe I used to scalp a little bit more. But my average hold time last week was 41 minutes for my winning trades. My losing trade, 14 minutes. And so I'm cutting my losses quick, and I'm holding my winners long so I can take advantage of those big moves. And so I don't know if you caught our class yesterday, but we kind of went over this stuff. And this is really what you want to see. If I had to critique this, my losing trade was only a little bit smaller than my average winning trade. And so I should work on that. But my accuracy was 75% last week. But that's what you want to do. You don't want to scalp these moves. If you take a partial at the low of the day, that's ultimately going to help. That's going to help your accuracy rate, like Mitch says. And that way, if you see these moves here, let me pull it back up.
Yeah, I laugh here because I have a 14-minute losing time also.
Hey, man. Great minds think alike, brother. But the point is that you're not trying to scalp here. You're trying to take big moves. You're trying to give yourself a lot of reward. The problem with scalping is that your reward typically isn't there. And so you try to compensate for that by using larger sizing when you're scalping, and it generally doesn't work out. It sometimes does if you can find a high accuracy setup, but in scalping, it's not about risk and reward. It's about using big size to quickly get in and out, and take advantage of a high accuracy setup. But with these type of trades, we're actually using positive risk and reward. Sorry, let me go back forward so we can get to. Here we go. So yeah, we're trying to take advantage of this whole move. And that's why one of my weaknesses, because Mitch and I both have our own weaknesses and strengths, one of my weaknesses is selling a little bit too early. As you can see by my stats from last week, I've kind of did a little bit better with that. But again, you can see your risk in this trade, judging it off of these levels here. If you look at these levels, they confirm your risk. So for instance, you can see the confirmation of the risk. Support here, here, here. And really, if I kept going back, there would be more support at this level. And so that's a really obvious risk level in this type of trade, in this VWAP fade. And so again, your risk level's here. Your reward level is here. This is your risk in this trade. This is your reward. And so that's what you want to try to do with each trade, is give yourself these positive ratios. And regardless of what strategy you're using, you can find these positive ratios in each strategy you try. And so some strategies are going to be more accurate than others. The VWAP fade's probably my favorite strategy. But there's the VWAP rejection. And sometimes the VWAP rejection actually presents you with a little bit better risk to reward in those trades. And so it doesn't matter the strategy, but you want to do this with each single trade you get into. Here's your risk. Here's your reward. Substantially bigger reward than your risk. And I'm stressing it because that's the important thing new traders should understand, that if you want to find consistency, you got to map out your trade. You have to plan your trade. You have to calculate risk and reward in each trade you get into. And when you do that and you do well at that, then you're going to start seeing more consistency. Let me erase these here. Alright, so the next strategy we're going over is the VWAP rejection. It's very, very similar to the VWAP fade, but this short pattern uses the VWAP area to reverse a bullish or rising trend. And when you combine it with proper risk and reward, it can be a profitable strategy if you approach it correctly. Just to touch on one thing really quick before we get into this, is that if you enter these type of trades too soon, it's going to negatively affect your risk and reward. And so if you get in this area right, I thought about this, I should probably go over this, but if you get into this stock here, your risk is tight. But if you jump in too soon, anticipating the move to the VWAP, say you get in here, your risk is all the way up here. So your risk and reward level is substantially worse, and your reward is here. So it's about 1-to-1 if you get in right here. And so the lesson behind that is to be patient. Wait for your actual entries, because even if you calculate your risk and reward correctly in that trade, if you try to jump in too soon, your risk and reward ratio is going to be completely different. And so in order for this to be fulfilled, in order for you to execute this strategy correctly in any strategy you choose, you have to not only calculate your risk and reward, but you have to have the patience to wait for your entries. And we went over our trades yesterday in yesterday's class. One of my big holes in my game, even though I had a perfect week, I didn't have any losing days last week. But one of the biggest holes in my game was what? It was getting in these too early. And that negatively affected my risk and reward. And as you see from my stats, my average winning trade versus losing trade was almost 1-to-1. My average winner was a little bit bigger, but not by much. And that's the hole in my game from last week, is that I jumped in too early. And you can see it in my trades. All right, so moving on to the VWAP rejection. Like we said, the VWAP rejection is very similar to the VWAP fade. The biggest difference is that whenever you look for a VWAP fade, you're going to be looking for a big washout at the open. You're going to be looking for a big drop at the open, to kind of confirm that it may fade off of the VWAP. But with the VWAP rejection, you're looking for a big push at the open like this. So it's not a big drop. It's a big bullish push, a big push up. And so like this says, you look for a bullish trend in that stock. You wait for a solid reversal underneath the VWAP, so you can see a big downward move here with high volume. And then you look for it to get rejected off of this VWAP area right here. Now, what this effectively is this is a stock changing trends. So when it breaks under the VWAP, that's effectively the stock changing trends. It's changing its trend from a bullish trend above the VWAP to a bearish trend underneath the VWAP. And when it tries to come back after it broke underneath the VWAP, it gets rejected. And so it gets rejected and it confirms that bearish trend. And that's why you see these big drops after that, is because all the other traders are watching this in the VWAP, understanding that it just tried to change trends. And when it gets rejected here, they all jump in because they know the stock is changing trends from a bullish trend up to a bearish trend down. But aside from that, you really approach it very similar to the VWAP fade. You get in at the VWAP here, you take a partial at the previous low, and you ride it down to the next support level. And like I said a little bit earlier, is that the thing with the VWAP projection, the reason I like the fade a little bit more, is that the fade has a little bit higher of an accuracy rate. But the VWAP projection can present you with much better risk and reward. And so, for instance, if you're in this trade here and you get in right here at the VWAP, you could set your risk level right, let me draw it, right here. Why? Because it confirmed it there, there, and there. So this is a very obvious risk level. And your risk is tiny in this trade. So like if you enter the stock here, your risk is only from these two differences. A tiny risk. And your reward can be all the way down here at this low of the day. And so if it does follow through and actually get rejected off of the VWAP, then your risk in that trade can be substantially tighter and your reward can be much better. Like I said, I back tested these strategies, and the only thing about the rejection is that it's not as accurate. You know, it doesn't follow through as much. And that's okay, because even if it's only accurate, even if it only works 50% of the time, if you're giving yourself 2 to 1 or better reward to risk in those trades, then you can be 50% accurate and still be really, really profitable trading these. But you do want to understand that, and it's kind of a longer game. Like we went over in another class, you got to let probabilities play out. You know, if you know you're giving yourself good risk and reward in those trades, you have to understand that you might take a few more red trades than you're used to. And that's okay, because if you're giving yourself more reward than risk and you're following those levels like glue, then it doesn't matter, because the long game's going to even out and it's going to be beneficial in your favor regardless. So we can move on a little bit. Let's see. All right, and so the last strategy I wanted to go over in today's class is the washout long. And so some people call this the red to green move. And these moves happen a lot in the market as well. Typically, I like to find these whenever the SPY is in a bullish trend, but we can go over this one really quick as well. And we'll go over a few more strategies in the rest of the week. But you can see a good example of it is here. So with a red to green move, or a washout long, I like to call it, it's one of the first strategies I ever actually used. Many traders look for the first high of the day break and they jump in right at the high of the day break. You know, this is an older graph, but I actually don't like to do that. I actually prefer to wait for it to hold pre-market support. And with this setup, you can take advantage of the momentum of it switching from a bearish move to a bullish move. And so to show you really what I mean with I want to see it hold pre-market support, the washout long is simple. You look for a big drop at the open, you wait for it to quickly move back up, and you take advantage of that big breakout that possibly will happen once it breaks this high of the day. But to show you what I mean by this, here's an example of a washout long. I can't remember what stock this was. Mitch, you and I were going over this earlier. Do you remember what stock this was, man?
This is this is with the Kron. This is Kron.
Okay. And so, like I said, you look for a big, you look for a medium-sized drop at the open. If it's too big, it's going to have to work too much to get back up there. But you look for a medium-sized drop at the open. And what I like to do with these type of trades is I like to map out the pre-market support and resistance, and then I like to wait for it to hold some of those levels as support. And a lot of times I'm using these off of half and whole dollars. Like for instance, this was the whole dollar, I think of 8, maybe 7. But you can see I prefer it to wait for it to hold these levels as support. You can see the support right here and the resistance here. And if I move this over, it runs right into this level here from pre-market. And then this level of support in pre-market. And so with most of these strategies, you're letting pre-market guide you in this trade. You know, you're looking for the major support and resistance in pre-market. You're drawing those on your charts, and then you're waiting for those levels to hold, basing your support and resistance off of those levels. And so again, You look for a big drop at the open, wait for it to pull back, and when it holds this previous high and this pre-market resistance as support right here, that's your cue to jump into the trade. And you can set yourself a pretty tight risk here. You can set yourself a risk of down here. So your risk in this trade, let me see if I can draw it out. This will work. Okay, so your risk in this trade is this. And so pretty tight risk, and your potential reward, like I said, going back to pre-market, can be here, because this is the area that it confirmed the most. It had a lot of resistance here. And so your reward is there. And so your reward is much bigger than your risk. A little bit better than 2 to 1, it looks like. And another thing you want to understand about calculating risk reward is that it's all subjective. Certain people are going to use different levels than you are. And that's okay, because as long as you give yourself a good ratio, you're going to find consistency in those trades. And that's one of the biggest reasons I use pre-market as my guide, is because a lot of traders are watching those levels in pre-market. A ton of traders are looking at those levels and analyzing those support and resistance points. And so it just makes sense to let those areas guide the trade, especially if you're taking strategies like this that are really attacking the open. You know, strategies that are so close to the open like this, they're not midday, they're not after hours. Pre-market support and resistance levels are going to be major in these trades, because that's the most recent support and resistance levels for you to base your trades off of. You know, and that's what all the other traders are looking at as well, because it was so recent. To where if you're using, if you're trading midday or you know, a little bit later on in the day, say power hour, they might not be as viable. I'm not saying they're not going to work. A lot of times they still do work. But especially at the open, these levels are going to be extremely relevant, speaking about pre-market support and resistance, because that's the most recent levels for traders to make their thesis on. And so if you look at those levels, you'll see a lot of the time, specifically at the open, the stock will follow those support and resistance levels from pre-market. And again, this is a good example. You can see it found support here, resistance here, and if I go over, it runs right into these levels here. Look at all the resistance here, look at the support here. And so it confirmed that in pre-market, and that's where I would enter if I was in the washout long. You know, you could set a risk of, it's all subjective, but if I was in this trade, I would either set a risk of here. I'd probably prefer to set it here at this previous low right here, or I could set it at the previous high of the day. Previous high of the day would give me a much tighter risk, maybe from there. And so a tiny, tiny risk. But when you set a risk that small, your accuracy is definitely going to decrease, because, you know, a lot of times the stock's just going to move up and down and just stop you out real quick. And so it's a fine line between giving yourself too much room and not enough. And this is a good example of it. We can also go over, let me see. Last few things to go over. I think that's basically it with charts, but we'll go over a quote. He who is not courageous enough to take risks will accomplish nothing in life. Muhammad Ali. And he's right. In trading, you know, I talk to a lot of traders all the time, and one of the biggest things is hesitancy. They're too hesitant in their trade. They're too nervous to get into their trades. And that's a big flaw. But if you do something over and over again, and you condition your brain to be used to it, it will get much easier on you. You know, if you're too nervous about it and you don't actually ever try, then you're never going to get there. The key to success in trading is conditioning your brain. You have to condition your brain to analyze the risk and reward levels, to create a plan within your strategy before you get into the trade. You have to condition yourself to actually take the trade. You have to condition yourself to look at the pre-market support and resistance levels. And when you do that over and over and over again, it will become much easier. It'll become almost second nature in your trades. And that's the goal, because that's going to lead to consistency. You know, like we said, a lot of times traders are just kind of mindlessly jumping in trades, not giving themselves organization, not giving themselves levels to follow, not giving themselves a plan. And their trading reflects that. If you're just blindlessly jumping in a trade, if you get mad about a loss and you just keep jumping in trades and keep jumping in trades over and over and over again, your trading's going to reflect that. Trading, you want to make yourself organized because one, it will help your emotions in that trade. If you have a logical plan to follow, you're not going to be as emotional. But if you just blindly jump in trades over and over again, you're going to panic. You're not going to know what to do. You're going to force trades. You're going to revenge trades. And your profit and loss is going to reflect that.